All right, guys, a summary, a short 5-7 minute video of what was part three, so an example of a trade or a couple trades. 5 easy steps that should be part of any trade that you execute, especially the first 3. And the first one is, what is it you do to create a bias? I'll show you one simple way. Another is qualify it. What's going to get you to sit up in your chair, and then what's going to get you to pull the trigger. Ready, aim, fire. Those are 3 important elements to setting up any trade that you're looking to take. Managing your risk, step 4, and then some psychology. That doesn't have to go into every trade you make, but when people look at psychology, they look at it the wrong way. They think it's what's missing. No, what's missing is knowing what you're doing. These top 3 steps. And then the psychology or coaching could help. But that's the way this course has been designed. Every step of a trade is a section or a step in the program. So we put videos together on how to create healthy opinions or bias, how to qualify those bias. Step 3 then is pulling the trigger. This is everyone's number one weakness. Manage your risk and so forth. So there's 5 steps to it. And I want to go over it in an example from the day I did this webinar. And I have recordings of the price action on that day. So let's blow it up and take a look at it. Now, let the high definition take over. What we see here is, I'm going to pause it because all of this is just a bunch of colors on the screen and candlesticks, rotation. Seems like a lot of noise. I don't want you to look at anything other than what I'm going to explain. Number 1, this green line here is a big, what's called iceberg. It's a big resting buy order who is doing 700. He's done 700 and he's showing 100, which means he's got a lot more to buy. An iceberg is simply more than meets the eye. In this case, he's green. It's a buyer. Funny thing happened. Right in here, he moved it lower. So we're tracking him. So he's still in the market, but he's lower. This creates a bias. We explain it in step 1. A bearish bias. Why? These orders, when they're big enough, become magnets. And if price is above a magnet, you should be bearish. And if you're bullish, just be less bullish. But a magnet and price above creates, the price is saying, come to me, come to me. The why it's a magnet is explained in step 1, but I'll briefly explain it now. When everybody sees big buying come in, what do they want to do? They all want to jump and get long. So they do. And maybe it goes up a little bit. But all the people who jumped and got long because they seen a big buyer are now sellers. Remember, after you buy it, you're a seller. So longs equals sellers. Too many longs, and it has to go down. It's like a self-fulfilling prophecy. It goes back down where you got the reason for why you got long in the first place. So let's just look at this bearish bias that you would have objectively because price is above this iceberg. You don't have to get short, but if you want to execute a bearish bias, maybe this is the qualifier of a bearish bias you already have for another reason, but you're looking to play this market from the short side. Let me rewind it a couple beats here because the ready, aim, fire, the fire of the ready, aim, fire happens right in here. I just rewound it about a few, maybe 10 seconds. Now, you have to remember a few things. We're waiting for, let me pause it. We're bearish because of this iceberg below us, and it's a magnet. We are looking to get short, play it from the short side. But we can't just sell anywhere. Can't just sell price. Even if you got resistance up here, you don't just sell it against that. It's not going to work consistently. But you use order flow, and in this case, a big buyer that comes in. And most people would say, well, wait, Anthony, if you want to get short, why would you want a big buyer? You want to buy it with buyers. No, you want to see buyers not be able to move price up and then sell it. You're actually reading order flow, and you're reading an order to come in and not do what it should do. But big buying should make price go up. So then let me start this video. If you're already aimed at looking to get short, you already have your objective bias. Now you're using order flow to get your rear end short. Maybe you're bearish for another reason. Maybe you're a profiler, or maybe you're looking at some other things and your execution and timing is bad. This is what matters. So if you look at profile trades and they work, it's because this dynamic played out. When this dynamic plays out, it doesn't mean there was a profile set up there. So there's the big buyer that just came in. Let me rewind it. There he comes. There he is. Now, the reaction is not just the price firing up to the upside. This has to get you to either pull the trigger and get short or get ready to get short when it gets underneath this purple box. Purple box is for big buyers. All right. Now a big resting buyer comes in below. You could see over here what we call shorts puking. It's a webinar in and of itself, but it's another get short type of dynamic. And a lot of guys will wait for the price to get underneath this big buyer because then they have the risk identified, which is part of step 4 in the program. It's like, do you sell it right away or do you wait for it to breach it below? And there's two ways or two schools of thought. Either way, you know what should happen in a pretty timely fashion. You shouldn't rally up that much. You should be able to, if you have a magnet, you should be able to get it to go your way ASAP. Some guys wait for that, what just happened there. This is another, these two vertical lines are a shorts puking. So if I want to get short, I don't want a million other people getting short, because if a lot of people are short, a lot of people are buyers. If a lot of people are buyers, it's hard to go down. And if you're short, you want to go down. So right in here was shorts that were puking, which means they're no longer short, they're no longer buyers. So anyhow, you had the purple box of a big buyer came in, really couldn't get the market to go up. You had some shorts puking. A lot of guys would wait for that. That is being patient. That's the step 3 of qualifying your trade without some sort of randomness that otherwise exists. Like, oh, I'm going to sell it at 11 even. Why? Because 11 even is a moving average cross, and it's an LVN. It's all these other these lines that aren't the governing principle of what moves price. So it's like, well, you know, you need order flow, you need stuck, trapped longs, you need shook out shorts in order to put yourself in a position to have the market do this and go to what you have accurately assumed to be the magnet, which is the big green iceberg. Now, this recording is from a trading room that I do daily. So this analysis is done as it's happening, not obviously on a recording, but it's important to play back the ready, aim, fire. The qualify your bias, aim, get ready for it, and then B, fire or pull the trigger. So you could see, does this price have to go all the way down to your target in order for it to be a winning trade? No, your first goal is to just get the damn trade to start going your way. So there's another example with this same iceberg creating a downside bias, and it's at 249, because this price goes down and then it shows you an opportunity. Don't stay long or don't stay short. Well, let's go to 249 because I don't want this video. It's like a Cliff Note video of part 3. I don't want it to go too long. 249, we had what I call becomes like an elbow buyer. Why is it an elbow buyer? Well, it's a long stretched range. And then if indeed a big buyer comes in, it can't go up and go straight down. It looks like it's like an elbow or shoulder that coming out. I don't want to get into head and shoulder patterns. I'm not a big pattern guy unless you could see it develop as it developed and know exactly why it might be a pattern. But anyhow, this is a big buyer that comes in. If you're still bearish, why? Because that green iceberg's still below. You're using this to put yourself in a position to find the timing and the location to get short with the minimum risk and the maximum chance of it going your way ASAP. Because a lot of your what you already construed as psychological issues, fear, all this other stuff, when you strip out randomness, all that fear goes away. All of a sudden, a lot of your psychological problems are addressed. You didn't have to read a book. You didn't have to do meditation or breathing exercises or yoga. Now, here's a big seller that came in that gave you the choice and the opportunity to cover some of your short position. But again, you feel like this green iceberg is a magnet and you look for an opportunity to get in. Now, let's back it up. Look at this. Big buyer came in. Why didn't it go down there? Because price doesn't always, might have some big sellers like it did in here they had to shake out. The bottom line is you get a big buyer to come in. Look at the time it gave you to take a little profit or scratch it. never took a lot of risk. And then you put them back out. You fight for your location. But if you know what you're looking for, it doesn't seem like a fight. You got to create some effortlessness into your trades so it's not a giant struggle and fight every time you pull the trigger and press the mouse. Always, I'm going to end this. It's over 10 minutes. If the information gods came down to you and asked you what information you want, not something in the future that they don't know, something that they know that we don't know, you better know the answer. And it isn't some nifty secret and profile or some nifty secret in oscillators or stochastics. It's other people's positions and where other people put their stops. That's what this community continues to unveil, continues to create a togetherness of more eyes and ears on that stuff, executing around that stuff, period. That's what you're actually looking for or looking at with this, what we call our puke tool, not just big buyers and sellers and icebergs, but along here where stops came out. Very important. Hope you join the ETG community, but this is part 3, kind of a summary and cliff note of our longer couple-hour video in Understanding Why, the Understanding Why series. There's more examples like that in the other video. Just remember that all the steps are laid out like you would break down a trade. Stay safe, guys.